All right, so one thing about business to business sales is they're almost always on credit, right? That would mean that most of the transactions between a wholesaler and a retailer are going to be on credit. So much so that if you are a wholesaler, you you have to offer credit terms, because if you fail to do so, companies will elect not to do business with you, right? Um, so credit terms. Um, with credit terms, typically they're going to be stated in a manner which we'll see on the next slide. But there's a credit period, right, which is how long um, the customer has to pay the invoice, all right? So there's a credit period, and the discount period is offered. Well, it's a discount offered for early payment or quick payment of an invoice. All right, so if companies pay within the discount period, they get to take advantage of a discount. Outside the discount period, um, well, you pay the invoice price. All right. So here's an example of credit terms. This is your the two. So you would say there's 210 net 30, which is the most common credit terms, and this is from the date of the invoice. All right. So this is telling me that I am entitled to a 2% discount, or the customer is entitled to a 2% discount if they pay within 10 days of the invoice date. All right. Outside of 10 days, the net amount, which is the invoice less any returns or allowances, is due within 30 days. So that's the way you read that. And the numbers can change. So sometimes this is 210 net 30. You can also see 110 or 315 net 45. I mean, they vary from industry to industry and from company to company, but that's how you read those. So in the first position is the discount percentage. It means I take a $2 discount on a $100 invoice if I pay within 10 days. Or alternatively, I could pay the full 100 on day 29 if I wanted to. All right. Um, and so you might ask, why are we crediting the discount to merchandise inventory, the $10 discount? Because doing so actually leaves inventory valued at what the company actually paid for the inventory. So the invoice cost was $500, but the company actually paid $490, right? And that is what we see in the inventory account. Okay, so let's talk about purchase returns and allowances. So a purchase return is not unlike when you take something back to the store, right? The merchandise is returned to the seller, the supplier, and if it's already been paid for, the buyer is entitled to a refund. If, as is far more common in business-to-business transactions, if the sale was on credit, then the buyer is entitled to a credit to their account. All right. a purchase allowance is similar, but with an allowance, the buyer keeps the merchandise and they just pay less for it, or sometimes don't pay for it at all. And what it is a reduction in price for unsatisfactory merchandise. All right, so that is a purchase allowance. Both purchases, allowances, and returns are contra revenue accounts. All right, if you remember that term contra, it means opposite. So revenue has a normal credit balance. Purchase returns and purchase allowances would have a normal debit balance. And of course, we subtract that from revenues to get to net sales when we are making our income statement. Okay, so let's talk about transportation cost. All right, goods can be shipped FOB shipping point or FOB destination. All right, goods shipped FOB shipping point means that ownership has transferred from the seller to the buyer right here. So when goods are shipped, the buyer now owns them. All right, and generally that also means that the buyer pays for transportation costs. So when goods are shipped FOB shipping point, buyer pays for the transportation costs, and they're recorded as an increase to merchandise inventory. So you might say, why are we increasing inventory as opposed to recording delivery or transportation expense? And the reason being is that for inventory, all costs necessary to get inventory on site and ready for sale increase the merchandise inventory asset account. All right. The other way goods can be shipped is FOB destination, which means ownership transfers here. All right. Typically in this case, the seller pays for shipping and they record shipping cost as a delivery expense. All right. So one thing to keep in mind is that when merchandise is sold, there are 2 journal entries to record instead of just 1. All right. The first is your revenue transaction. So this commonly takes one of 2 forms. If it's a cash sale, obviously you debit cash, credit sales revenue. If it is for on credit, then you debit an account receivable and credit sales revenue. All right. The second entry required when goods are sold is the recognition of cost of goods sold expense. All right. So expense is a debit, so you'll debit cost of goods sold and credit the merchandise inventory account. All right. So we'll spend a lot of time in class working through these, but just keep in mind that we have 2 journal entries for every sale. Record the revenue, record the cost. All right.